Start by understanding what inflation actually means. Inflation is the rate at which the general level of prices for goods and services rises, leading to a decrease in purchasing power. In simple terms, when inflation is high, your money buys less than it did before. This concept is central to economics and affects everyone, from individuals to businesses and governments. Inflation is measured by tracking price changes in a basket of commonly purchased items over time. Understanding inflation is the first step to grasping how it shapes economies and daily life. Inflation isn't just an abstract economic term, it has real-world impacts. When prices rise, the cost of living increases, affecting everything from groceries to housing. For businesses, inflation can mean higher costs for materials and wages, which may be passed on to consumers. Governments monitor inflation closely because it influences interest rates, wages, and even social stability. Understanding why inflation matters helps us see why it's a key focus for policymakers and economists worldwide. Track inflation. Economists use several key indicators. The most common is the Consumer Price Index, or CPI, which measures the average change in prices paid by consumers for goods and services. Another important metric is the Producer Price Index, or PPI, which looks at price changes from the perspective of producers. These indices help governments and businesses make informed decisions about spending, investment, and policy. Accurate measurement is crucial for understanding inflation's true impact. Inflation can be caused by a variety of factors. One common cause is demand pull inflation, which happens when demand for goods and services exceeds supply. Another is cost push inflation, where rising production costs like wages or raw materials lead to higher prices. Sometimes inflation is influenced by monetary policy, such as when central banks print more money. Each cause has different implications for how inflation is managed and controlled. Demand pull inflation occurs when the demand for goods and services outpaces supply. Imagine a booming economy where people have more money to spend, but there aren't enough products to meet everyone's needs. This increased competition for limited goods drives prices up. Demand pull inflation is often seen during periods of economic growth and can be fueled by factors like rising wages, increased government spending, or strong consumer confidence. Cost push inflation happens when the cost of production rises, forcing businesses to increase prices. This can be due to higher wages, more expensive raw materials, or supply chain disruptions. For example, if oil prices spike, transportation and manufacturing costs go up, and these costs are often passed on to consumers. Cost push inflation can be particularly challenging because it's often linked to factors outside a country's control, like global commodity prices. Central banks play a crucial role in managing inflation. They use tools like interest rates and monetary policy to keep inflation within target ranges. When inflation is too high, central banks may raise interest rates to cool down spending. Conversely, if inflation is too low, they might lower rates to encourage borrowing and investment. The actions of central banks are closely watched by markets and can have wide-reaching effects on economies around the world. Globalization has changed the way inflation spreads and is managed. With interconnected economies, a price shock in one country can quickly ripple across the globe. For example, a disruption in the supply of a key commodity like oil can affect prices worldwide. Global supply chains mean that inflation is no longer just a local issue, it's a global one. Policymakers must now consider international factors when addressing inflation. In recent years, inflation trends have shifted dramatically. After a period of relatively low inflation, many countries have experienced sharp increases. Factors like pandemic-related supply chain disruptions, rising energy prices, and increased government spending have all contributed. These trends have forced central banks and governments to rethink their strategies and take new measures to control inflation. COVID-19 pandemic had a profound impact on global inflation. Lockdowns and restrictions disrupted supply chains, leading to shortages and higher prices for many goods. At the same time, governments injected large amounts of money into their economies to support businesses and individuals. This combination of supply constraints and increased demand created a perfect storm for rising inflation rates worldwide. Energy prices play a significant role in driving inflation. When oil, gas, or electricity prices rise, the cost of producing and transporting goods increases. These higher costs are often passed on to consumers, leading to broader inflation. Recent spikes in energy prices due to geopolitical tensions and supply issues have been a major factor in the latest wave of global inflation. Supply chain disruptions have become a common theme in recent inflation discussions. When key components or products are delayed or unavailable, prices can rise quickly. These disruptions can be caused by natural disasters, geopolitical events, or even labor shortages. The global nature of modern supply chains means that a problem in one region can have far-reaching effects on prices everywhere. Wage growth can also contribute to inflation. When workers demand higher pay, businesses may raise prices to cover increased labor costs. This can create a cycle where higher wages lead to higher prices, which in turn lead to demands for even higher wages. Managing this wage price spiral is a key challenge for policymakers, especially in tight labor markets. Currency values can have a big impact on inflation. When a country's currency weakens, imported goods become more expensive, driving up overall prices. Conversely, a strong currency can help keep inflation in check by making imports cheaper. Exchange rates are influenced by many factors, including interest rates, trade balances, and investor confidence. Interest rates are one of the main tools used to control inflation. When inflation rises, central banks often increase interest rates to slow down borrowing and spending. Higher rates make loans more expensive, which can reduce demand and help bring prices down. However, raising rates too quickly can also slow economic growth, so finding the right balance is crucial. Most central banks set inflation targets to guide their policies. These targets are usually around 2% per year, which is considered healthy for economic growth. If inflation moves too far above or below this target, central banks adjust their policies to bring it back in line. Clear targets help anchor expectations and provide stability for businesses and consumers. Hyperinflation is an extreme form of inflation where prices rise uncontrollably, often by more than 50% per month. This can devastate economies, wiping out savings and making everyday transactions difficult. Hyperinflation is usually caused by a collapse in confidence in a country's currency, often due to excessive money printing or political instability. Thankfully, hyperinflation is rare, but its effects are severe and long-lasting. Deflation is the opposite of inflation. It's when prices fall over time. While this might sound good, deflation can actually be harmful. Falling prices can lead people to delay purchases, which slows economic growth. Businesses may cut wages or lay off workers, leading to higher unemployment. Deflation can be difficult to reverse and is a major concern for policymakers. Stagflation is a rare and challenging economic situation where high inflation occurs alongside stagnant economic growth and high unemployment. This combination makes it difficult for policymakers to respond, since measures to reduce inflation can worsen unemployment, and vice versa. Stagflation was a major issue in the 1970s and remains a concern when economies face multiple shocks at once. Emerging markets often experience higher and more volatile inflation than developed economies. Factors like political instability, weaker institutions, and reliance on imports can make inflation harder to control. Currency fluctuations and external shocks can also have a bigger impact. Policymakers in these countries face unique challenges in maintaining price stability while supporting growth. Developed economies like the US and Europe typically have more stable inflation rates. Strong institutions, independent central banks, and diversified economies help keep inflation in check. However, even these countries are not immune to global shocks, as seen in recent years. Understanding the differences between developed and emerging markets helps explain why inflation trends can vary so widely. Inflation can erode the value of savings over time. If the interest earned on savings is lower than the inflation rate, the real value of your money decreases. This makes it important for individuals to consider inflation when planning for the future. Investments that outpace inflation, like stocks or real estate, can help protect savings from losing value. Investors pay close attention to inflation because it affects the returns on different assets. Stocks, real estate, and commodities often perform better during periods of moderate inflation, while bonds can lose value if inflation rises unexpectedly. Diversifying investments and understanding inflation risks are key strategies for protecting wealth in changing economic conditions. When inflation rises, consumers often change their spending habits. People may cut back on non-essential purchases, seek out discounts, or switch to cheaper alternatives. Businesses may respond by adjusting their product offerings or pricing strategies. These shifts in behavior can influence the broader economy and even affect how inflation develops over time. Governments use a variety of tools to respond to inflation. These include fiscal policies like adjusting taxes and government spending, as well as regulatory measures to control prices or support vulnerable groups. The effectiveness of these responses depends on the underlying causes of inflation and the specific circumstances of each country. Expectations about future inflation play a big role in shaping actual inflation. If people expect prices to rise, they may act in ways that make inflation worse, such as demanding higher wages or raising prices preemptively. Central banks work hard to manage these expectations through clear communication and consistent policies. Technology can both increase and decrease inflation. On one hand, advances in technology can lower costs and improve productivity, helping to keep prices down. On the other, rapid technological change can disrupt industries and create new sources of inflation. The net effect depends on how technology is adopted and integrated into the economy. Commodity prices, like those for oil, metals, and food, have a direct impact on inflation. When these prices rise, the cost of goods and services often follows. Global events, weather patterns, and geopolitical tensions can all influence commodity prices, making them a key factor in global inflation trends. Climate change is increasingly affecting inflation. Extreme weather events can disrupt food production, damage infrastructure, and create shortages, all of which push prices higher. As the world adapts to a changing climate, these effects are likely to become more pronounced, making climate policy an important part of inflation management. Geopolitical events such as conflicts or trade disputes can have a major impact on inflation. These events can disrupt trade routes, limit access to key resources, and create uncertainty in markets. The resulting supply shortages and increased costs often lead to higher prices for consumers and businesses alike. Food prices are a major component of inflation, especially in developing countries where food makes up a large share of household spending. Factors like weather, transportation costs, and global demand can all influence food prices. When food prices rise, it can have a significant impact on overall inflation and on the well-being of vulnerable populations. Housing costs, including rent and home prices, are another key driver of inflation. When housing becomes more expensive, it puts pressure on household budgets and can lead to demands for higher wages. Housing inflation can be influenced by factors like interest rates, population growth, and local regulations. Healthcare costs are rising in many countries, contributing to overall inflation. Advances in medical technology, aging populations, and increased demand for services all play a role. Managing healthcare inflation is a major challenge for governments as it affects both public budgets and individual well-being. Transportation costs, including fuel and shipping, are closely linked to inflation. When these costs rise, the price of goods and services often follows. Global supply chain issues, fuel price spikes, and infrastructure challenges can all contribute to higher transportation costs and, by extension, higher inflation. Education costs are rising in many parts of the world, contributing to inflation. Tuition fees, school supplies, and related expenses can put pressure on family budgets. As education becomes more expensive, it can also influence wage demands and broader economic trends. Inflation doesn't just affect the economy, it also has social consequences. Rising prices can increase inequality, as low-income households spend a larger share of their income on essentials. Inflation can also lead to social unrest if people feel their standard of living is threatened. Addressing these impacts requires thoughtful policy and support for vulnerable groups. Inflation can have mixed effects on debt. For borrowers, inflation can make it easier to repay loans since the real value of debt decreases over time. However, lenders may lose out if interest rates don't keep up with inflation. Managing these effects is important for both individuals and financial institutions. Rising inflation can pose challenges for retirees living on fixed incomes. If the cost of living increases faster than pension payments or savings returns, retirees may struggle to maintain their standard of living. Planning for inflation is a key part of retirement strategy, including choosing investments that can keep pace with rising prices. Digital currencies like Bitcoin are sometimes seen as a hedge against inflation. Their limited supply means they can't be devalued by printing more units, unlike traditional currencies. However, digital currencies are also highly volatile and not widely accepted, so their role in inflation management is still evolving. Inflation can widen the gap between rich and poor. Wealthier individuals often have assets that rise in value with inflation, while lower-income households spend more on essentials that are rising in price. Addressing inequality is an important part of managing inflation's broader effects on society. Inflation and employment are closely linked. Moderate inflation can support job growth by encouraging spending and investment. However, high inflation can erode wages and reduce consumer confidence, leading to job losses. Policymakers must balance the goals of price stability and full employment. Inflation affects a country's competitiveness in international trade. High inflation can make exports more expensive and imports cheaper, affecting trade balances. Exchange rates and inflation are closely linked, and shifts in either can have significant impacts on global trade flows. Looking ahead, managing inflation will remain a complex challenge. Factors like technological change, climate risks, and shifting demographics will all play a role. Policymakers will need to adapt their strategies to address new sources of inflation and ensure economic stability in a rapidly changing world. Sum up, inflation is a complex and ever-changing phenomenon that affects every aspect of our lives. Understanding its causes, impacts, and the tools used to manage it is essential for individuals, businesses, and governments alike. By staying informed and adapting to new trends, we can better navigate the challenges and opportunities that inflation presents. As we look to the future, understanding global inflation trends will be more important than ever. With rapid changes in technology, climate, and geopolitics, the factors driving inflation are constantly evolving. By keeping a close eye on these trends and adapting our strategies, we can build more resilient economies and societies for the years ahead.